Did you know that 63% of seniors lose money in retirement not because of bad luck, but because of 5 preventable investment mistakes? One wrong move could cost you thousands, or worse, your financial security. If you care about your well-being after 60, hit like and subscribe right now, because on this channel, we expose the simple mistakes and habits that quietly harm your health, safety, happiness, and financial independence. Mistake 1. Investing too conservatively and missing growth opportunities. Many seniors make the mistake of moving 100% of their investments into bonds, CDS, or money market accounts because they think they need to be safe. But here's the hidden danger. You could live another 20 to 30 years in retirement, and ultra-conservative investments won't generate enough growth to keep up with inflation and rising costs. If you're only earning 2 to 3% while inflation runs at 3 to 4%, your purchasing power actually shrinks every year. That means the money you have today won't buy as much in 10 or 15 years. Being too conservative is actually risky because you might outlive your money. So what should you do instead? Keep a balanced portfolio that includes some growth investments. There's a common guideline that can help you here. Subtract your age from 110 to determine your stock allocation. So if you're 70, that's 40% in stocks for growth and 60% in bonds for stability. You need some exposure to stocks because they historically outpace inflation over the long term. Consider dividend-paying stocks or equity index funds that provide both income and growth potential. Work with a financial advisor to create an age-appropriate asset allocation that balances safety with necessary growth. Have you moved all your investments to safe options and noticed your money isn't growing? And here's something even more shocking. The next mistake involves putting too much faith in one type of investment. Mistake 2. Over-investing in individual stocks instead of diversified funds. This is one of the riskiest investment mistakes seniors make. Maybe you're holding large positions in your former employer's stock, or you've invested heavily in a few sure-thing stocks based on tips from friends or TV. Here's the brutal truth. Individual stocks can lose 50%, 75%, or even 100% of their value if the company fails, and it happens more often than you think. Enron, Lehman Brothers, General Electric, all were once considered safe, solid companies. Seniors who had concentrated positions in these stocks lost fortunes. At your age, you cannot afford to lose big chunks of your portfolio because you don't have decades to recover. The fix here is straightforward. Shift your investments from individual stocks to diversified mutual funds or exchange-traded funds, what we call ETFs. These funds spread your money across hundreds or even thousands of companies, so if one fails, it barely affects your overall portfolio. Index funds that track the S&P 500 or total market funds are excellent choices with low fees. If you currently have more than 10% of your portfolio in any single stock, that's too concentrated. Start selling gradually and reinvesting in diversified funds. Your former employer's stock might have treated you well, but loyalty doesn't pay your bills if that company tanks. Which mistake do you recognize? Investing too conservatively or putting too much in individual stocks? But wait, the third mistake involves an investment type that seems safe but carries hidden dangers. Mistake 3. Chasing high-yield investments without understanding the risk. When seniors see an investment promising 8%, 10%, or 12% returns, they jump on it without asking why it's paying so much more than safer alternatives. Here's the danger. High yields almost always mean high risk. These could be junk bonds from shaky companies, risky real estate ventures, or worse, outright scams targeting seniors. Fraudsters specifically target retirees with promises of guaranteed high returns or safe, high-yield investments. If it sounds too good to be true, it absolutely is. Thousands of seniors lose their life savings every year chasing unrealistic yields, only to discover the investment was worthless or the company goes bankrupt. Here's what you need to understand. Higher returns always come with higher risk. Period. If someone promises you 10% returns with no risk, you're being scammed. Stick to investments with reasonable, market-rate returns. Currently, that's around 4 to 5% for safe bonds, and historically about 8 to 10% for stock index funds over the long term. Before investing in anything promising unusually high yields, ask yourself, why is this paying so much more than treasury bonds? Research the company thoroughly, check if they are registered with the SEC, and consult with a fiduciary financial advisor. Never invest in something you don't fully understand, no matter how attractive the yield sounds. Comment "I'll fix this" if you've been tempted by high-yield investment pitches. And the next mistake? It involves a tax bomb that catches thousands of seniors off guard. Mistake 4. Ignoring the tax consequences of investment decisions. Too many seniors make investment moves without considering the tax impact, and it costs them dearly. Selling investments in taxable accounts triggers capital gains taxes. Taking large withdrawals from traditional IRAs creates huge tax bills. Converting too much to a Roth IRA in 1 year can push you into a higher tax bracket. Some seniors unknowingly trigger taxes on their Social Security benefits by taking investment income at the wrong time. Others hold tax-inefficient investments in taxable accounts when they should be in IRAs. The result? You could be paying thousands of dollars more in taxes every year than necessary, money that could be staying in your pocket and working for you. Here's how to protect yourself. Develop a tax-efficient investment strategy with a financial advisor and tax professional. Hold tax-inefficient investments, like bonds and REITs that generate regular income, inside your IRA where they grow tax-deferred. Keep tax-efficient investments, like index funds and municipal bonds, in taxable accounts. Before selling any investment, calculate the tax impact. If you've held it less than a year, you'll pay higher short-term capital gains rates. Consider tax loss harvesting, which means selling losing investments to offset gains from winners. Plan your withdrawals strategically. Take some from Roth IRAs, which are tax-free, some from traditional IRAs, which are taxed as income, and some from taxable accounts, which use capital gains rates. This way you minimize your overall tax burden. Have you calculated how much you're losing to taxes on your investment decisions each year? But here's the 5th mistake, and this one involves expensive advisors who might not have your best interests at heart. Mistake 5. Working with commission-based advisors instead of fiduciary advisors. This is the investment mistake that costs seniors the most money over time. Many seniors work with advisors who earn commissions on the products they sell: annuities, loaded mutual funds, insurance products wrapped as investments. Here's the problem. These advisors are legally allowed to recommend products that benefit them financially, even if there are better, cheaper options for you. They might put you in a variable annuity with 3% annual fees when a simple index fund with 0.1% fees would serve you better. They might churn your account, which means making unnecessary trades, just to generate more commissions. They are salespeople, not fiduciaries, which means they don't have a legal obligation to put your interests first. You're paying inflated fees and getting investments chosen for the advisor's benefit, not yours. So what do? Fire your commission-based advisor immediately and hire a fee-only fiduciary advisor. Fiduciaries are legally required to act in your best interest at all times. They charge transparent fees, either a flat annual fee, often 0.5 to 1% of assets under management, an hourly rate, or a fixed project fee. They don't earn commissions, so there's no conflict of interest. Before hiring anyone, ask 3 questions. Are you a fiduciary 100% of the time? How are you compensated? And do you earn commissions on any products you recommend? Get it in writing. Also check their credentials. Look for the CFP designation, which stands for Certified Financial Planner, and verify they have no disciplinary history on FINA's broker check website. Yes, you'll still pay fees, but you'll pay far less and get unbiased advice. Comment below if you've never asked your advisor how they are compensated. This is your wake-up call. When you correct these 5 investment mistakes, you protect the nest egg you've spent a lifetime building. You stop overpaying in fees and taxes. You avoid risky investments disguised as opportunities. You work with advisors who are legally obligated to put your interests first. And you create an investment strategy that balances safety with the growth you need to fund 20 to 30 years of retirement. If this video helped you catch even one of these costly investment mistakes, give it a thumbs up and share it with a friend who needs to hear this. Don't forget to subscribe. Our next video uncovers another everyday mistake that quietly affects senior well-being. Hit that bell icon so you never miss important information that could protect your health, safety, and financial security.